Up next, Tamryn Lamb, who's the head of retail at Allan Gray, is going to be delving into the nitty-gritty of it all with the chief investment officers of 3 South African asset managers. They're going to be exploring the challenges facing local investors and the opportunities that lie ahead. So please welcome Duncan Artus of Allan Gray, Karl Leinberger of Coronation, and Duane of 91 South Africa. And with that, Tamryn, I'll hand things over to you.
Okay, good morning, everyone, and thank you again for joining us today and tomorrow. And thanks to Alicia for that introduction. And as she mentioned, I've got the unenviable task of moderating between Duane, Karl, and Duncan. And we know we only have 45 minutes, and I have lots of questions, so I'm going to get straight to it. But before we do, we thought it might be useful to just do a little bit of context setting, because 2024 felt like an unusual, perhaps lumpy, quite sort of a year where returns felt quite concentrated. And if I look at that slide, there were sort of 3 themes I wanted to point out. The first is the one that we often talk about, and it's this kind of catchphrase of US exceptionalism. It seems to have remained the kind of game in town. The second is that the rest of the world seems to be lagging, but some of the EM markets are picking up. So we saw a rally in Chinese equities at the back end of the year, but sentiment still seems quite negative. And then if we bring it a little bit closer to home, we know that SA equities and bonds even more so did particularly well in 2024, but yet it doesn't seem to have been enough really to have brought foreigners back to our markets. So, you know, is it just a wait and see, or are people kind of still worried about the underlying fundamentals? So with that context in mind, I'm going to start with Karl, and I want to talk to sort of 3 themes that are quite general in nature, but actually more importantly influence how, you know, we put together the portfolio. So the first is geopolitics. The second is the sort of role of China, and the third is, you know, how well the US has been doing and how concentrated the markets have been. So I'm going to start off with Karl, and I'm going to say, Karl, if we had done this panel last year, we would have been talking about the fact that, you know, 2 billion eligible voters were going to the polls, and there would have been a lot of discussion potentially about what the impact of that would have been. So now that we look back and we can see the results of those elections, and Trump's just recently kind of been inaugurated, and let's say we roll forward 5 years, are we going to look back at this year and say it was a pivotal point in history and it's influenced markets and there are some important trends that we should be taking account of? Or are we going to actually just chalk it up to another year of noise and it actually isn't really relevant for investors?
Yeah, I don't think it's noise, and I don't think it's an inflection point. I think it's very much the same. It's a continuation of a trend we've been seeing for at least a decade, which is that it was like a year of the shiny new thing. So the incumbent was rejected pretty much across the globe. And I think that's the first time it's happened at that scale in more than a century. You know, there's normally a thing, the incumbent's advantage. And I think it talks to deep-seated issues. I think we've got increasing polarization within societies. We've got increased inequality. We've got people consuming news and building out worldviews from social media instead of reading, you know, formal media. I think there are a whole lot of forces playing out, and it's manifesting with these electoral outcomes. And I think we're probably only in the early stages of that, because once you throw AI into the mix and the trauma that is going to bring to societies, you know, even if AI results in net job creation, there are going to be big winners and losers within society. And if you look at the discontent in the sort of Midwest of America from sort of manufacturing moving to the East, that's a fraction of what's coming with AI. So I think I'm all in an optimist, and I think all in there's exciting opportunity for those economies and businesses that are prepared to grab the opportunities that are out there. And some will do, and there will be enormous value creation. But there is a lot for societies and economies and the politics to absorb and adjust, and we're going to have to change the way we do things. So I don't think it's noise. I don't think it's insignificant, but I don't think it's anything very new. it's what we have been seeing for much of the last decade.
Okay. So perhaps talking about that polarization, it does feel, Duane, like there's no better example of that than the US. But if you look back at 2024, it was another year of, great returns in the S&P 500, but concentrated in a handful of names. So it's like the great American dream seems alive, but as Karl says, maybe it's not really alive. Maybe what's your view on that? And we've been calling the top of that for a while. What causes it to unwind, if it does?
I mean, sort of continuing from where Karl left off, I mean, the concept of US exceptionalism is alive and well. And if you look at the markets try to time a new game in town, whether that was China, whether that is EM, for the last couple of years, and that trade you've been found wanting. And if you look at valuations, you can kind of understand why the market is making that assertion. If you were to land from Mars and just look at the strong returns out of the US market, ratings relative to history, it would be easy to make the case of this cannot continue and things need to normalize. Our view is maybe a little bit different. So, I mean, I'm personally quite optimistic about the future for the US, and I think US exceptionalism would continue, which is maybe different from the rhetoric of sort of bubble and normalization that you hear. And a couple of things that I look at, if I look at just underneath the index, you mentioned concentration, and the stock-specific opportunities you look at, valuations are attractive. I look at the Magnificent Seven that everyone talks about, and yes, valuations are stretched, but they've been supported by strong, robust earnings growth. And if you look at ratings, relative to the tech bubble of 2000, it's very different. And so when I take a step back and I say, can this continue? As a student of history, you look at how often have you had the US market go up by more than 20% for 2 consecutive years, and the third year was also up double digits. In history, that has very seldom happened. The last time that was in the late 90s. And if you look at the late 90s with what happened in internet, you saw more than 20% returns from the S&P for 5 consecutive years. And if you think through what's happening with AI, to the point that Karl made, some real changes in terms of winners and losers and where valuations are, I think you can construct a stock-specific case. And just a tangible example I will end with, if you look at the peak of 2000, Cisco was trading at a 200 times multiple. You look at the poster child, and we don't have exposure to NVIDIA, but if you look at where it's trading at today, just north of a 30 times multiple, and so nowhere close to sort of the peak euphoria that we saw towards the early part of 2000. And so I would think the path of least resistance for us is a continuation of the trend in the US, supported by superior earnings growth that has driven the stock market.
Okay, so you guys are a little bit more in the camp of this time it is different. So I'm going to not ask my question that I had lined up, because I feel I have to give your peers a bit of a chance to rebut. So maybe, Duncan, you haven't had a chance to talk yet, which is unusual for you. So what do you think Duane might be missing?
I actually don't think he's missing too much. I mean, if you look at our portfolio, I mean, the US is like whichever index you pick, somewhere between 65 and 70% of the world's equity values there. It's the deepest pools of capital, so you're going to find things there. So even though Orbis and ourselves would generally say the US, you can find better opportunities from a valuation point of view outside the US, you're still going to find lots of opportunities there just because the capital markets are so deep. And I have to say, since we've been running our portion of the portfolio from Cape Town, the one thing that does strike you is American companies, a lot of them are just of much higher quality, and the management's better, and they're much more shareholder friendly than a French company or a UK sort of company. So I think you're always going to find opportunities. But to Duane's point, if you just took 20 valuation measures and you said, where does the American market sit now? It's like in the 90th percentile. So like, on any maths, just to go against Duane's sort of history thing there, 5-year forward real returns from this valuation, like you don't normally get more than 1 or 2% real. But you're always going to find sort of opportunities there. Yeah, so I agree and I disagree, if that makes sense.
Okay. So then...
I also want to say, so I'm also a great believer in American exceptionalism. Just parking the valuation of the stocks, I think what a lot of commentators and observers in Europe and the UK are trying to get their minds around is just why the economy does so much better and why American businesses do so much better. And I think there's a major sort of reckoning for the UK and for Europe and Japan, China in a lot of ways. Wherever you look in America, this is an environment in which economies and businesses will thrive. It's very light on regulation. They embrace growth. You look at American management teams, they're obsessed with returns. Everything they look at is through the lens of return. It's hard to find UK or European management teams that will refer to returns. And certainly you've got to be counterweight against multiple other considerations and multiple other masters they're trying to serve. And I think that the deep pools of capital that support tech, the talent pools, the attitude to immigration, of course there will be some changes with Trump, but I'd be surprised if the fundamental DNA shifts much. This is where the world's winning businesses are, with the world's best management teams, working for shareholders, and they look more future fit to me than most other developed nations that I see. And so there's a lot of noise and there's a lot of social issues that need to be navigated. But fundamentally, at your core, you've got an economy and business that's fit for purpose, fit for the future, I think.
Okay, well, let me try and flip the question, because now you're all agreeing unusually. Where would you avoid investing in the US, given 76 of the top 100 companies are now US listed? There have to be pockets of overvaluation there.
Yes, I mean, my take would be, if you think through the market, there are definitely businesses, high quality businesses, that have lagged in this market. So it's been a very momentum driven market. You've seen what's driven the earnings, and some valuations are stretched. And to Duncan's point, there's very little margin for error in some companies. I mean, if you think of Tesla, the likes, I spoke a little bit earlier about NVIDIA. There's other pockets of the market that you can play. So finding those winning businesses where the valuations are still palatable, where management is fighting for you and the chances are in your favor from a return perspective, we still think there's attractive opportunity. So just very simply,
so that's not where
if I think of the Mag 7, the only, which is the topic du jour, the only two we own is Microsoft and Google. And if I think through the others, some of them are great businesses like NVIDIA, but valuations are baking in very little margin for error.
Okay, well, let me shift to the kind of the emerging part of the world. And sometimes when I read commentaries on China, I wonder if the Western narrative misses something. But there is a very sort of wide range of views. It's either completely uninvestable, or it's this coiled spring of opportunity. So, Duncan, what is your view, and how important is it for you to have a view on that when building the portfolio?
I think everyone knows my view after all the years. So, it's one of the few things we've got right. China's been a terrible place to invest in equities if you convert it into US dollars, even if you strip out the SOEs, which bring down the index. So, and you can see just announcing a slight sort of stimulus. I've never seen a big market go up vertically like China did in September, but amazingly, you've already retraced about 20% of that. If you think Tencent went from 360 all the way to almost 500 all the way back to 360. So I think let me just put it straight. Even within the Allan Gray investment team, there's quite a bit of disagreement, right? There's some people who are quite bullish, and this is a market that's been depressed for years. The way I've heard it best described, so there are two things. One, you spoke about the investable, uninvestable. No matter what you think, that's quite important. And we saw what happened to Nasdaq's share price last week, right? And so if you look globally, a lot of the Australian superannuation funds, a lot of the big US defense pension funds, they want an EM ex China. Right, so no matter what you think personally, that's a definite trend. The best way I've heard it described is by a friend of mine, which is the problem in China is not monetary policy and it's not fiscal policy, it's communism. And Xi doesn't care about Duane, Karl and I. And he doesn't care that the average South African fund has 15% in Naspers. If Tencent goes to zero to keep the Communist Party in power, or for whatever reason they want to do, they'll do it. And so for us, it's far more about risk control. I mean, you might have a slide later, I'm not sure, but if you look through the balanced fund, I mean, our biggest position is still Naspers, but it's way lower than most of our competitors. And when we put our portfolio together with Orbis, how we more think about it is, yes, they're cheap opportunities, but we limit the percentage of the portfolio that can be in China, because you don't want to have an extinction event like Russia, where you wake up and the average equity fund in South Africa loses 15% in one day. And so, but you don't know. So it's very difficult, because how do you put geopolitics, how do you put the Chinese Communist Party into a spreadsheet? You can't, right? So it's just thinking about it and trying to put some common sense. But if you ask me, could there be a very strong short-term rally? Yes, there could. The long-term things, Chinese consumer confidence is very low. The demographics are shocking, right? And everyone knows we've sort of seen this thing with the world sort of splitting in two. And what I found most interesting about China, and I think the way you can actually play it, is lots of the multinationals that have issued profit warnings over the last year have been because of China. And so you can actually buy American-listed companies or European companies that maybe earn 20% of their revenue from China, and their share prices are off significantly because China's disappointed. I mean, we saw in Richemont's trading update last week, I mean, China's still falling double digits negative, right? So I think that's maybe a way you can do it, where you don't get the risk of China invades Taiwan and all the shares, you can't trade in them.
Okay.
If I can maybe add, I mean, a lot of what Duncan says resonates with me, and also with the 91 divergence of views. But I mean, for me personally, I mean, I think that's the one potential surprise that lies ahead for the market. I mean, personally, we've got a team that's based in Hong Kong, visits China regularly, gives all the feedback. But for myself, I mean, I've been there twice in the last 2 years. And the one thing that I think the market underestimates, despite a very tough macro, there's significant amounts of innovation going in, some really top-class companies trading on very attractive valuations. And had they not been listed in China, would trade at much higher multiples. And yes, I agree with Duncan, longer-term structural trends. Yes, consumer sentiment is low, but on the same side, expectations are quite low. And when I think through the growth outlook for some of the best-in-class companies in China tech, the likes of a Tencent, the likes of a Meituan, the likes of a Hong Kong Stock Exchange and others, when you see the runway for growth, despite a tough macro and where the market is pricing in, a potential pocket of the market that can surprise. I think everyone is fixated now on Trump and tariffs and China being the whipping post. As we've seen, when things just go a little bit better than the market anticipates, there's potential value. Yes, you've got to risk size it, so think about portfolio construction, but encouraging when you meet the companies and the management teams, they're a little bit more capitalist than what the Western media would want you to believe.
Okay. No, that's useful. So talking about portfolio construction, and maybe it's now a useful time to bring up the slide which shows the three main funds of Allan Gray, 91 and Karl. And this is just a quick snapshot, kind of profiling each of the major asset classes, and it shows the respective positionings in SA equities and property and bonds, and then obviously cash, and then shifting to offshore. So some of the kind of key differences that I wanted to talk about here, where there are some different views in SA equities. So Karl and Allan Gray are at similar overall levels, but Allan Gray has a hedge. 91 is a little bit lower in SA equities, so I want to start there. And then we can talk to SA bonds, and then we'll sort of delve back into the foreign exposure. So if we look at the SA equities, Karl has probably the modestly higher allocation on a gross basis to SA equities. When you look at the run last year, and you look at what drove the underlying rally in equities and which equities kind of ran harder than most, what's your view on the potential for SA equity returns over the next 3 to 5 years?
Yeah, you've got to be so careful with the SA equity market, because there are three very different markets there. There's the resources, there's global companies that happen to be listed on the JSE that have got nothing to do with South Africa, and that's quite a small basket of companies, so that's quite stock specific. And then there's domestic SA Inc. businesses, which are about a third of the market, and they've all got very different profiles and different valuations. So it is quite tricky. I think so. What I'm trying to say is there's an enormous. I think that stock picking's always been important in South Africa, and all three of these firms have delivered very compelling alpha over long periods. So stock picking's always been important, but I think perhaps more so in the next 5 to 10 years because the market's become narrower. It's all about big views on certain key big stocks, and I think that. So it's quite difficult to take a view in aggregate. I think, for example, there will come a time when commodities are very cheap, and then you want to own a lot of them because they tend, the cycle's very extreme there. They tend to become very cheap, and then you have a very big opportunity. So I think that with good stock picking, double-digit returns from SA equities is very plausible on a 5 to 10 year view. There are not many very expensive companies. I think on the domestic side, the big thing you've got to get your mind around, and I don't think any of us know the answer, is what's the future for the SA economy. We've had a major rally in domestic assets. The ratings are super high. And if this new government doesn't hold, or if it holds and doesn't deliver growth, then you're in very big trouble with these domestic stocks. Their earnings bases are low, so I think in a better environment, these businesses could surprise. But will that happen? Will this government hold, or if it holds, will it deliver growth? We haven't seen economic growth in South Africa for a decade. So I think, and we're watching things closely with an open mind.
What do you think would cause foreigners to return?
The foreigners have been burnt in multiple emerging markets where they've been badly run. Whether it's Turkey, whether it's Brazil, whether it's South Africa. Have had very bad experiences. They came in with Ramaphoria and they learned a lesson. And it doesn't look like they're going to make that mistake again. They're going to need to see economic growth, and they're going to need to see earnings growth. And I think the foreign indifference to South Africa also needs to be seen in the context of all the returns in the US. So money's poured out of emerging market funds for a decade. So that whole ecosystem's actually been hollowed out. Most EM managers have lost 50, 60%, 70%
You don't think
of
they're
capital.
natural buyers?
So they themselves are sitting on small asset bases. They've got a market like India, which they're all heavily invested in. So I think that when you look at the question of why this little foreign money has come into South Africa since June, part of it is what they experienced in 2017, but the other part of it is just the sort of malaise in emerging markets and the amount of money sitting in the US. And I think that actually has created a lot of opportunity for stock pickers in emerging markets. There's some fantastic businesses that are trading on much lower multiples they would trade at in normal times because the spotlight's elsewhere. The money's elsewhere.
So, Duane, it would seem like you sort of somewhat agree with that because if we look at the overall positioning, and this is an oversimplification, but there seems to be an overweight to SA bonds rather than SA equities. Do you want to explain that view?
Sort of, you think of where the differences are. I mean, obviously we think around the challenges around South Africa that Karl highlights as well known, state of the fiscus, lack of economic growth, how are we going to pay for everything, who's going to come after Cyril. When we look at SA bonds and we look at how much is in the price, whether you look at the real yields you're getting, whether you're getting yields versus cash, versus other emerging markets, we just think a lot of the bad news is in the price. So we understand from a fiscal perspective, things are likely to deteriorate over the next 5 years, but not as bad as what the market has priced in. And then we think about that hurdle rate relative to the opportunity set, and probably where I would differ with a Karl and probably a Duncan would be when we think of the hurdle rate that SA bonds offer relative to SA Inc. So we've got to eat a little bit of humble pie. I mean, we've been lowly positioned on SA equities and missed the run in the portfolio. But when we think of the hurdle rate that bonds offer relative to domestic equities, we didn't feel like we were being compensated for the risk in the SA Inc. equities, whereas in SA bonds, you were being compensated. And we can see it in the whole discussion around global and foreigners. Foreigners will respond based on market returns. And to Karl's point, they're starting to do the work. They haven't really pulled the trigger yet. And it's fair based on the yield. If we start to see tangible evidence, there could be some good upside in the bonds. And the way that we see it, just my last point, is from a portfolio construction perspective. Given our large global position, it's a nice ballast in the portfolio from a risk-adjusted returns perspective.
Okay. Duncan, and from Allan Gray's perspective, how are you trading off SA equities relative to bonds? And given Karl and Duane's comments, where do you think then would be the biggest area of opportunity
I just wanted
locally?
Just to put it into context, Charlie is doing the presentation, but South African bonds outperformed Brazilian bonds by 50% last year. So it's not like, they had a big move, right? So it just shows if things go slightly wrong, the people do sell off. So I just the one thing I find a little bit more difficult is I think they're both interlinked. If the South African long bond goes back to 13, I promise you the banks are not going to be trading where they are today. So it's not a little bit like which one's better and which one's worse, but it's clear that's been part of the rally, right? So the cost of capital's come down. As Karl mentioned, the growth hasn't come yet. People expect growth, and you just do your UCT year one equation, and that gives you a higher PE, right? So both those things can reverse. So I found it a little bit tricky. I think the one thing, so we were wrong last year. So we obviously had bonds, but we didn't have enough duration. And what we noticed in some of the bond auctions was it was getting quite thin. So I don't think you noticed that as a small manager, but we have to bid in size. And there was getting a stage where if you actually haven't done Jafekra, which I still call an accounting trick, right? So, that's what caused the bond markets rally. I think half the government to national unity, half Jafekra, and people can ask afterwards what that is. And, if you hadn't done that, that took like 120, 150 billion rand of issuance out the way. If you go 2-3 years more forward and you're not growing, just to give you an interesting example, the spread to Mexican bonds now is 0. And Mexico's got much better fundamentals than South Africa. So I think they're both intertwined, to be honest. If I could get on the short end a similar yield closer to the long end, I'd rather be on the short end. I think that's perhaps the better way to say it.
Okay, well, maybe I'll ask each of you quickly, where do you think the greatest area of opportunity is domestically? So one quick answer and why?
Well, I think the greatest opportunity, but we don't own it yet. If you say what could double, the only thing in my head that I think could double is platinum, but I'm not sure if that makes sense. We're still doing a lot of work. That's the reason why they can double, right? Because it's in there. But yeah.
Karl?
Yeah, that's very far from my mindset. We've just had such a rally. So, actually our minds are all about protection of capital here. And it doesn't look like South Africa's traded well in the last few months. So, to be honest, we're doing a lot of work and a lot of thinking about, where you could lose money. But I think for me, the big point I'd make in the South African economy is that in times of stress, the strong get stronger and the weak get weaker. And there are some very strong businesses that have done very well over the last decade and continue to surprise. And I think many of those are still the best and most exciting investments because these are businesses that through market share gains are growing whatever the economy does. But it's hard because the market's not stupid and those losing businesses are quite cheaply priced. And there are a lot of cheaply priced companies that if the economy does grow, trading on 5-6 times earnings, that if the economy does grow could be fantastic investments.
Yeah.
So I think there's quite a lot of tension, there's quite a lot of tension here between the various scenarios that could play out. And we aren't being dogmatic about it. We've been very open-minded and trying to, see how things are playing out and whether the bulls are right, the bears are right, and we'll adjust things accordingly. I don't think with one can say with conviction this is what's going to happen. I think that the election last year was a remarkable outcome. I would put the probability of what happened at less than 1%.
Yeah. Less than 1?
Yeah.
Okay.
Because I think there were 3 surprises that compounded here. The first was that the ANC didn't lose a few percent. It lost enough to need a large party and not a small party. Then one would have thought, had that happened, they would have gone with the EFF, not with the DA. And then the third surprise is you would have thought that in working with the DA, it would be a disaster.
Yeah.
And yet when you speak to enough people on both sides in that coalition government, you get this resounding feedback that things are actually working okay and they're working well together. Now, I don't know if that lasts, but those 3 surprises, if you'd said to any of us a year ago, what is the probability of the DA being in government with the ANC, and they're agreeing on a lot of hard things. NHI, Bella, these are like hard, difficult, existential questions for both parties where they're diametrically opposed in their views.
Yeah.
I don't know if they can hold, and I don't know if they can deliver growth, but we are we're already on that sort of very low probability road.
Okay. So with that in mind, Duane, I'm going to ask you again also where you think the area of opportunity might be, and maybe just, do you also think because we're quite close to it and we've been through it and we've seen the cycle that we're maybe also a bit jaded?
I don't think so. As investors, we all have to be pragmatic. To Karl's point, we can't be dogmatic. The market humbles you over time. And reality, when you look at the situation, how much markets have rallied, if you think specifically SA Inc., to make meaningful money from here, you need to believe in the real structural change and growth coming. And if that doesn't happen, there is pockets of risk everywhere. But fortunately for South African clients, you don't just have to invest in SA Inc., which is the point that Karl made earlier about the lots of different opportunities. And if I think through how much the dual listers, for example, in SA equities lagged last year, the valuations we're seeing, if you think of something like a Naspers process, given its exposure to Tencent, given my comments around China, there's still significant upside on our valuations without thinking about taking too much risk outside of the general risk that comes from China, which you can constrain in a portfolio context.
Okay, great, thank you. So just when I think about SA equities and how it's been a bit of a lost decade of returns, one of the, I think, consequences of that is that you've seen the absolute level of returns and the dispersion of returns across some of the main South African multi-asset funds be quite low over the last decade, or certainly when you look at that range of outcomes, it's quite tight, and it's a lot tighter than it was in the preceding decade. So Duncan, I'm going to ask you, you could have actually thrown darts when it came to asset allocation, and you probably would have got roughly...
So we're going to hire Luke Littler.
Exactly. He's done well. He's quite young. We haven't... Those of us on the panel, we're probably you would all call yourself good asset allocators, but we haven't really stood out as much as we would hope to do. So is asset allocation as easy as it's looked over the past kind of decade, or is the last decade an anomaly, and it's going to be a lot more important and a lot more difficult over the next 10 years?
It's also a tricky thing because it's how do you measure it? Do you measure it against yourself?
Yeah.
You could rebalance 60-40 every month. You can say, actually, why bother with asset allocation? Just every month I'll go 60-40, 60-40, 60-40. I think the thing that some people miss is one that I think asset allocation is hard. Like to even add 1 or 2% per annum, if you actually go and do yourself against your own efficient frontier, when we did it last time, was tricky. The thing that makes it more tricky for me is, if you go to where the team sits up here, the fixed income team sits with the equity team sit on all the fixed income policy groups, so we won. So it feeds in. And when we actually go and look at the asset allocation, we've added far more by equity alpha than by asset allocation. But when I look at the equity alpha, a lot of it had to do with, was I bearish or bullish? So how do you separate sort of the two? And I do think the people who believe in building blocks, who just take 20 managers and stick them all together, you don't get what we have sort of up here where everyone, the equity people can put input into the fixed income. Oh, we just met Tiger Brands. They're telling us about food inflation. You can be meeting the government. Oh, by the way, the trains are not working. How's ARM going to get the iron ore to the sea? So you can put it all together. So I do think it's difficult. Where do you add those returns is normally at extremes. And we haven't really had an extreme since 2008. COVID, you could say, was an extreme, but sure, it was a valuation thing. You woke up and the world was shut down. So I do think it's difficult. And I do think you need sort of 1 or 2 extreme events to differentiate between the managers. Because I know the slide you're talking about, because we use it. There's very different, very small between asset classes. There's been very close returns, and between the managers, there's been very close returns. So there really hasn't been a way where you go, okay, I had this, and unless you were a very small manager and you had I don't know, some tiny shares, your top 10, I don't know.
Yeah, so I'd have a very different view there. I do agree that I think asset allocation is the most important decision you make in investments. And I think it's the most important, and I think it is, I agree it's hard. But I think that there's the opportunity to add massive value. And when we look at our funds, we see very big value add from asset allocation. You just look at the last 15 years, and the GFC was a stunning opportunity. The bull market in South African assets that finished in 2013, to be very light in SA assets at that time. The opportunity, incredible opportunity that COVID presented to make lots of money. Then with the changes to Reg 28, the opportunity to move before this very big rally 3 years ago. I mean, at that time, global, if you remember, Reg 28 changes were at the time that global equities and bonds were melting down. Yeah. The incredible opportunity to allocate a large part of the portfolio into those very cheaply priced assets. So I think there is opportunity for very big value add, and I think also the world, we've lived through so many unforecastable things. Who knows what's coming? I wouldn't be comfortable with a mechanistic asset allocation that has worked in the past. I don't know what's coming, but I know for my money, I'd want it with people I back who, with an open mind, are going to respond to what happens. So yeah, we're very big believers. I think the dispersion has already widened massively since 3 years ago, since Reg 28 changed. True. And I think that's a precursor to what's coming. There's more of that to come. As people decide whether I'm going local, I'm going offshore, I'm going into emerging markets, I'm going, there's opportunity for so many more offshore asset classes. Pre the Reg 28 changes, equities crowded everything out. I think it's super exciting.
It's also been a one-way move in a lot of those market trends. Duane, would you add anything?
I mean, I would say,
another question about momentum. But
I'll get there, but maybe just, it's something that I'm quite passionate about, because, I do think that the asset allocation skill is underappreciated in the local market for exactly the point you raised in terms of trending markets. Your value is driven at inflection points, but importantly, when I look forward based on return expectations, opportunities in the market, definitely opportunities to create value for clients from an asset allocation perspective, because asset allocation is incredibly hard when you don't just have one-way trending markets, where it's only about one asset classes, more fundamentals driving markets. I do think the opportunity set to create value via asset allocation will become appreciated, where probably in the last 5 years it was really only appreciated at times of extremes.
Okay, so before I get criticized of allowing you all to talk to your book, I'm going to ask a question around one big theme over the last sort of 10 years, maybe even longer, is that things have been very momentum driven. So it feels like the rewards for bottom up stock picking haven't really kind of been there. And when we look out into global markets, the flows into passive sort of don't necessarily look like they're abating. So it sort of feels like that sort of trend could continue. So I don't know, Duane, I'll pick you because you're closest to me. What do fundamental stock pickers, for want of a better description, do in that environment? Do you adapt your process? Do you just wait for ride out the cycle?
I think it's incredibly important to know who you are, to understand your process, and make sure that you're always asking the tough questions. So specifically, if I were to think from a 91 perspective within the quality capability, is understanding how your process works and evolves over time, and sticking to that with a blank sheet of paper, and making sure that you are not too dogmatic and understand where maybe you make mistakes. I think that's the type of market we are operating in, and if I think through maybe where we are going forward, you are shifting into a less momentum market, where in a normalized capital cost environment, you don't have free money sloshing around anymore. So companies have to generate a good return on capital that drives earnings, and ultimately investors are going to follow where companies compound those earnings, which will drive better valuation. So I do think in a normal rate environment, away from just one-sided momentum, that it does create more opportunities for stock pickers to generate alpha.
Okay. And I've got one more sort of general question before I'm going to sort of end off with the final questions for each of you. And that sort of flows a little bit from this sort of trend that we've seen around passives globally, because that trend has disrupted active management and the overall landscape. So, Duncan, maybe I'll throw it to you. We've seen like a reasonable amount of consolidation globally and to a lesser extent locally in the asset management industry. And it does seem, and now I'm not talking to my own book here, it does seem like distribution's quite important, and Duane will probably agree with me here. What do you, if you were to like, I know we're not in the business of making predictions, but if you were to say, what do you think the asset management industry in South Africa will look like in the next 5 years? What comes to mind?
So I think we were talking about it earlier, the South African stock market in dollars is flat over 18 years. It's like running a retailer with no volume growth for 18 years, but your IT costs are growing in dollars, your IT staff are growing in dollars, and you just get squeezed. So every 3 or 4 years, you may have a good year in terms of alpha, so you earn some more performance fees, which you're able to pay out as a dividend. I mean, these two guys are listed, so we can see the results that happen. It's been brutal, like for me to be in the South African asset management industry, and it's fairly interesting if you look overseas. I mean, I'm not an expert on the asset management industry. You know more than me, Tamryn. There's people.
I'm asking the questions, though.
Yeah, I know. People put very low valuations on long-only managers offshore. Like if you're not in private credit, if you're not in private equity, if you're not in alternatives, now all those things can change, right? And it will probably need an event to change those things back. The interesting thing, I take it to leave aside our story here in South Africa. The one I really enjoyed, the one sort of thing with David Einhorn, because most of the great managers offshore, they've just lost all their assets. And he said the one problem with being a value manager now is there are no other value managers. So you buy a thing that's low, the earnings are low, the earnings come up, the P goes up, like you normally sell it to someone else, and you go, but like, now there's no one else on the other side. As Karl was mentioning with the money leaving emerging markets, that's just like the money that's left everywhere else. And the passive thing in the US is much bigger than I think the average South African investor understands if you look at the flow. So I think it's going to be difficult. And who knows, like in 5 years' time, you might be interviewing 3 ChatGPT people here instead of the 3 of us, if I look what's happening overseas. So I think it's going to be tough. And you can already see overseas, everyone's just going for scale. And managers that have strong distribution trade on higher multiples. Maybe the market's wrong by that, but that's the way it kind of works at the moment.
Okay.
If I can maybe opine, I mean, traditional asset management industry has become incredibly tough. And I mean, we see it at 91. I mean, we've got from offshore clients the bulk of our assets. So we've seen the global trends. Markets become more competitive, passive continues to grow. Ultimately, what it has meant for outflows for the industry has been significant. And if I think through the traditional asset management industry, in 5 years' time, unless you can show differentiated alpha, great client service with strong distribution, I suspect there's going to be a couple of casualties in the industry. And if I fast forward that to South Africa, a lot of the trends we're starting to see in South Africa now are what we've seen globally. And so you mentioned Sanlam, you mentioned the distribution agreement. From a 91 perspective, we've got some distribution agreements offshore. We think Sanlam does the same in the local market, and ultimately we think if as an investment firm we can stay independently owned, focus on investment alpha with strong distribution support, that we'll be able to be one of the winners. But you've got to say it with all humility that it is a very tough, difficult market, and you've got to be on your top game because all the competitors keep upping the intensity. Your edge continues to be challenged, and so you need to be quite humble, or the market's going to humble you.
Okay. Karl, is there anything that you want to add? Otherwise, I'm going to ask you another question.
Yeah, I'm very optimistic. I mean, I think that there's going to be lots of consolidation in the South African market, but this thing about passive, I think, it's very easy to get caught in a sort of doom loop about it, but I think it's stunning because I think the passive has moved way beyond a sort of healthy market share. It's massively undermined the price discovery mechanism. It's massively undermined the efficiency of markets. It's created a large number of stunningly cheap companies. And I think that ultimately the fundamentals will assert themselves, and these companies, you will make a lot of money from owning them. None of us, if this thesis is right, none of us know when it plays out. I hope it plays out while I'm still working, and because it will be remarkable. I think that good managers that make it through this period will deliver massive alpha, 20, 30, 40% alpha type numbers. I think good global managers can deliver. It's coming because these stocks are crazily priced. and we just all got to make sure we survive and play the long game and are there with capital invested, because it really is absurd, some of the pricing of stocks. It's been very damaging to the ecosystem efficiency of markets, and therein lies opportunity, I think.
Okay. I'm going to end off quickly, although I know they're telling me that we're probably slightly over time. But I'd like you all to end off with a sentence about your main flagship multi-asset fund and sum up kind of what you think, how would you summarize the kind of the overall positioning? And while I know you don't spend a lot of time comparing how your funds look like relative to your peers, maybe you could add to that summary why you think the fund is different, or perhaps what role it plays in a portfolio. Okay. Duane, you want to start?
Sure.
Okay,
So if I go to throw our flagship multi-asset fund in the advisor space is the Opportunity Fund, where I would say we are differentiated relative to what I see in the industry. I mean, obviously it's the alignment around the quality investment philosophy with one team based in 3 jurisdictions, Cape Town, London, New York, constructing a portfolio with a blank sheet of paper. Very different to what some of our competitors do. I mean, we've got highly respected competitors, but when we look at our performance footprint, we are competitive currently from a performance perspective. The 2 gentlemen on the right are giving us a little bit of a bloody nose, but we all go through the different alpha cycles. And when I think through what it does for clients, gives you a differentiated investment philosophy with a long-term track record that actually blends quite well in the market, and a very different performance footprint to our competitors, who we all rate and have respect for.
Okay, great. Karl?
Yeah, I think the Balance Fund, that's Coronation's flagship pre-retirement vehicle, and I think that we aim to deliver, the best risk-adjusted returns that we can, and I think that's valuable to investors in that fund. We've shown in bull markets that we will have very low exposure to assets, but when assets are reasonably priced, we'll take full advantage of it, and I think that the 25-year track record of the fund shows that. And my big message is we're optimistic. We think good returns can still be delivered.
Okay. Duncan?
It's hard to add anything. I do think the one thing where it's difficult when you come to distribution is, when I run my portion of the Balance Fund, I think as if I'm running 100% of someone's savings. I don't think, how does this fit together with Coronation and then 91? How do we do it? And I think try apply common sense. That's what I want to do. And just to echo Duane a little bit, I do think relative to some of the other managers in South Africa, it's a huge advantage to have Orbis with us to fit in. 40 analysts globally. They've built those systems over 3 decades. I mean, they have some really amazing quant systems, and we're able to use that without having to build the cost up here in South Africa. And then we can bring the South African lens to the portfolio and try sort of put it together rather than having 7 managers stuck in one sort of area.
Okay, great. So that wraps it up for our panel. Thanks very much for joining us.